Imagine foreseeing one of the biggest financial crises in history. One man did. His name, Michael Burry. Let's step into the world of Michael Burry, a name that rings a bell in the ears of anyone even remotely involved in finance and investing. Known for his uncanny ability to predict market trends and his unyielding knack for identifying potential economic downturns, Burry has cemented his place as one of the most successful and influential investors of our time. Born in 1971, Burry is an American physician-turned-investor who is best known for his role in predicting and profiting from the subprime mortgage crisis of 2008. A remarkable feat indeed. But how did a doctor end up becoming an investment guru? Well, Burry has always had a passion for investing. Transitioning from a career in medicine, he founded Scion Capital, a hedge fund company, in the year 2000. His reputation as a successful investor was not a result of mere luck or coincidence. It was his unique approach, his deep understanding of the market, and his ability to see patterns where others saw chaos that set him apart. His predictions were based on thorough analysis and careful observation, a testament to his diligence and intellect. One of his most notable achievements was foreseeing the 2008 financial crisis. He was one of the few who predicted the collapse of the housing market, a prediction that many dismissed as ludicrous at the time. But as we now know, Burry was right. His foresight and strategic investments helped him and his clients make substantial profits, even as the world was grappling with one of the worst financial crises in history. His insights and predictions have earned him a revered status in the world of finance. He's not just an investor, he's a soothsayer, a visionary, someone who can see the storm before the clouds even start to gather. Now, this economic soothsayer has a new warning for us all. Recently, Burry has been sounding the alarm on a potential housing crash. This isn't some horror movie plot, nor is it a work of fiction. No, this is a real-life warning from a man who has proven his mettle in the world of finance time and time again. So what's the fuss about? What is this financial oracle seen that's got him worried? Well, Michael Burry has been pointing out some alarming trends in the housing market that could signal a potential crash. One of the key factors he's highlighted is the escalating property prices. In many parts of the world, property prices have been skyrocketing at an unsustainable pace. When the cost of owning a home starts to outpace wage growth, that's often a red flag. He's also pointed out signs of an overheated market. An overheated market is one where the prices of assets increase rapidly within a short period, typically due to excessive demand or speculative investing. When this happens, it's usually followed by a rapid drop in prices, which can lead to a crash, but it's not just about the numbers and the data. Burry has been observing the behavior of market participants. He's noticed an increasing number of people jumping on the property bandwagon hoping to make a quick buck. This herd mentality can often lead to a bubble, and as we all know, bubbles eventually burst. Another factor worth noting is the low interest rate environment we're currently in. While low interest rates make borrowing cheaper, they can also fuel speculative investing and lead to asset bubbles. Now, it's important to remember that predictions are not certainties. They are based on observations and analyses, and they come with their fair share of risk. Michael Burry's warning is not a prophecy written in stone. It's a calculated prediction based on his understanding of market dynamics and his extensive experience in the financial world. So the million-dollar question remains, but what does this mean for you, the investor? Well, stick around because we'll be diving into that in the next scene. A housing crash isn't just a headline, it impacts real people and real investments. In the universe of investing, a housing crash means different things to different investors. For homeowners, it's a potential nightmare scenario with home values plummeting and mortgage balances remaining the same. The equity you've built up can evaporate almost overnight, leaving you in a precarious position. However, for a real estate investor with a keen eye for potential, a housing crash can signify a buying opportunity. As prices drop, properties that were once out of reach become affordable, and with the right timing and strategy, these can later be sold for a profit when the market recovers. Stock market investors also need to pay attention. Companies tied to the housing industry, such as construction firms, home improvement retailers, and mortgage lenders, can see their stocks take a hit. But again, for those with a long-term perspective, these depressed prices could represent a chance to buy shares in solid companies at bargain prices. On the flip side, let's not forget about the bond market. In times of economic uncertainty, Investors often flock to the perceived safety of government bonds, driving up prices and pushing down yields. This is something bondholders need to be aware of. And then there are the speculators, those who thrive on volatility. They might see a housing crash as a chance to short-sell housing-related stocks or even the broader market, potentially making a profit as prices fall. But let's be clear, whether you see a housing crash as a disaster or an opportunity depends largely on your individual circumstances, your tolerance for risk, and your investment horizon. And even then, timing the market is notoriously difficult. So, while a housing crash can indeed bring opportunities, it also comes with significant risks. It's a time when careful planning, prudent decision-making, and sound financial advice become even more critical. As they say, in every crisis, there's opportunity. But it's equally important to remember that in every opportunity, there's also a potential for loss. Therefore, navigating a housing crash, like any other investment scenario, requires a balanced approach and informed decisions. In the face of potential economic turbulence, how should one navigate? A question that's probably on many minds right now. But fear not, because there are strategies that you can employ to not just survive, but thrive, even in a housing crash. Let's start with diversification. The old saying, "Don't put all your eggs in one basket," rings true in wealth building. Diversification is about spreading your investments across different asset classes to reduce risk. If real estate looks risky, consider investing in stocks, bonds, or commodities. The key is to have a mix of investments that are likely to perform differently under varying economic conditions. Next up, risk management. This is all about understanding and mitigating potential losses. It involves assessing your risk tolerance, setting a clear investment goal, and regularly reviewing your investment portfolio. It might also mean setting stop-loss orders on your investments to limit potential losses. One cannot stress enough the importance of staying informed. In the words of legendary investor Warren Buffett, risk comes from not knowing what you're doing. So make it a habit to read financial news, follow market trends, and listen to experts like Michael Burry. Knowledge is indeed power, especially in the world of finance. Additionally, consider investing in recession-resistant sectors. These are industries that tend to perform well or hold their value during economic downturns. Think utilities, healthcare, and consumer staples. People will always need electricity, medical care, and basic household items, regardless of the economy. And lastly, remember the power of patience. Wealth building is a marathon, not a sprint. It's about consistent growth over a long period of time. So don't be swayed by short-term market fluctuations. Stick to your financial plan, adjust as necessary, and keep your eyes on the prize. These strategies are not foolproof, and they won't guarantee success, but they can increase your chances of building wealth even in uncertain times. After all, as the saying goes, fortune favors the prepared mind. Remember, the best defense is a good offense. So arm yourself with knowledge, develop a solid strategy, and you'll be well equipped to navigate any economic climate. In the world of finance, knowledge is power. We are in an era where the most successful investor of our time, Michael Burry, has once again sounded the alarm. The potential housing crash that he has warned us about could be a game changer in the world of investment and wealth building. Let's take a moment to recap the key insights from Burry's warning. He's pointed out a number of red flags that suggest we could be heading towards a housing market crash. These signals are not to be taken lightly, especially considering Burry's track record. He foresaw the 2008 financial crisis after all. So what does this mean for you as an investor or someone seeking to build wealth? It means that you must stay informed, monitor the economic landscape, keep an eye on market trends, and most importantly, heed the warnings from experts like Burry. Now, staying informed is just half the battle. The other half is about making informed decisions. In the face of a potential housing crash, this could mean reassessing your investment strategies, considering diversification, and managing risks effectively. Remember, every financial downturn also presents opportunities. As the saying goes, when others are fearful, be greedy. When others are greedy, be fearful. This wisdom holds especially true in times of economic uncertainty. And let's not forget, the world of finance and investment is not a one-man show. While Burry's warning is significant, it's also important to consider the insights from other financial experts and analysts. A balanced perspective is key in navigating the turbulent tides of the financial world. In conclusion, the potential housing crash that Burry has warned us about is a wake-up call for all of us. It's a reminder to stay vigilant, to stay informed, and to always make financial decisions based on careful analysis and sound judgment. And with that, we've come to the end of another episode of The Successful Nuggets. Stay vigilant, stay informed, and remember to subscribe for more wealth-building content.